Bruce, good to see you.
Hi, Alex.
What do you make of this?
Well, good CPI numbers today. Why? For two reasons. Number one, the market came in short, and so technically they were short. And so anything that came in on expectations, the market was going to rally. We saw it in treasuries, and we saw it in equities, and it's a big rally. The second reason is CPI, when you look at fundamentally, the numbers were pretty good, 3.4% on expectations. But when you look at the trailing 3 months at 4.1%, which is the last 3 months on average, that number still too high for the Fed. So it means higher for longer without a doubt. And you see goods inflation. You saw it with retail sales, but goods inflation a little soft. But the services and OER, which is owner equivalent rent, up around 6%, still too high, too firm. So I think it was perfect because for us bond guys and credit investors, it's Goldilocks, it's higher for longer, and we're making a lot of money off these higher rates. So and for the equity folks, the technicals are driving it, and the animal spirits are out.
So, okay, but you've been saying this for a while, the golden age for credit, you like lots of different things.
Yes.
Well, you have a favorite area of credit? Do you have an area that you don't like in credit?
Well, it's kind of like, and that's why I call it Goldilocks, because you look at the liquid credit markets, which is everything from high yield loans, they're ripping, nearly half of the high-yield bond index is trading inside of 200. 62% of the leveraged loan index is trading above par, so that's doing really, really well. Structured credit is crushing it. ABS, RMBS, CMBS, and CLOs. Yes, even CMBS is having a good run here, despite what's happening in commercial real estate, and then emerging market debt doing well. So in the liquid credit markets, which is like a total of 12 trillion, it's all doing really well. And do I have a favorite? Well, we are very selective in our bottom up in terms of what we invest in, and there's a lot of value right now, particularly in the structured credit sector compared to these other sectors. In private credit, it's, middle market lending, direct lending, it's asset-based lending, which is huge and going to get much, much bigger, and there's a lot of opportunities in capital solutions. So it's kind of Goldilocks for all credit, generally speaking, but there's a small cohort that is the tale of two cities, the other part that's struggling under these higher rates.
Is there any sort of correlation with those pockets and the areas you're talking about?
Well, there's correlation among commercial real estate, of course, Romaine. Yeah. And so, the banks are going to be very, very constrained because these new CRR, capital requirements under Basel III Endgame comes in, and it means you really have to lower down your LTV to make that same loan, or you're going to have a big capital charge. And so that's when private credit is going to lean forward and make loans. We've been very active there as banks pull back from extending commercial real estate loans. And the second part are companies that are just a little bit too levered, that need capital solutions. And then again, we're leaning in. And look, talking about leaning in, what's the big lean in? You got to look at Keith Gill and you got to look at the Roaring Kitty and just see that lean in. But the real Roaring Kitty, Jay Powell. And why I say that is because as of last October, with his words, he's been leaning in. And the equity market since last October, up 10 trillion. What did Keith bring to the table? He brought, GameStop, AMC, like 10 billion of value.
Is that
the Fed chairman and his litter? By the way, his litter is all the congressmen,
We're going deep in this analogy now.
Who put trillions of dollars of stimulus and has enabled the economy to be as strong as it is, and so that's the real Roaring Kitty. Yes, it's Keith, but it's Jay Powell is the big guy.
Do you worry at all, though? I mean, it's one thing to have a Goldilocks scenario where things are kind of stable, but when you start talking about kind of what we saw based on that Roaring Kitty tweet and all the animal spirits come back in here, does that not worry you that if we get to the stage of that euphoria again, then maybe that means Jay Powell then leans back in his chair and says, Bruce, settle down?
I think we're a little way away from that. I mean, we've been leaning into, say, AMC. So we're long AMC for like a year, 2 years, 3 years. And when you lean in and AMC goes running up, there's a lot of equity that the company can now raise, and that goes right into our pocket because we're earning 15%. Senior secured, leaned up against all their assets.
And they already did that.
We're debt with debt protection, and we're earning 15% thanks to Roaring Kitty and all the meme fan club that's buying up AMC.
So the debt issuance that we had announced yesterday by AMC, you think we're going to see more of that from some of these other stocks?
Oh, absolutely. When you raise equity, you raise that, and it's a combo platter trade. And we're long, kind of the senior secured stuff that we bought in the 60s, that went to 70s, 80s. They're now in the 90s, but we love them still in the 90s because we're earning 15% yield on that at a discount with all that equity cap that backs it now, and in a senior secured position.
I love that for you.
I love it for us.
Yeah, I
and our
bet
investors.
you do. What else do you like right now? What else is speaking to you?
Well, what's not speaking to me is treasuries. I think treasuries are kind of in this range. It's 4 to 4 3/4. I think is the inside range. 3 3/4 to 5 is the outside range. I think that our star is going to be high enough, and all the massive treasury issuance. So I'd be fading treasuries when it gets to, not today, but when it gets to like inside of 4, and I'd be a buyer kind of like in the 4 3/4 neighborhood or anything wider than that.
Do you not think we would break out of that range?
I think we're going to be in that range for a really long time, and I think you fade either side of that.
Yeah.
And in credit, buy it. And you buy it in liquid credit with multi-asset credit strategies, and you buy it in private credit with both middle market lending, asset-based lending, and some of these opportunistic strategies. Credit is the place to be. So private equity, right, done very well for a very long period of time. Private credit, which has a fraction of the risk of the leveraged private equity, fraction of that risk, because we're senior to it, right? And we have our fixed coupon that, and floating rate coupons that underrate that cash flow. Right. We outperformed that index of private equity last year, and the same thing will happen again this year. So I think allocations to equity has always been the rage, balanced with like maybe some hedge in treasuries. But now you can really balance a portfolio with credit because it yields so much, and you don't have to take the equity-like risk. So I like equities. It's broad-based now, right? S&P's up 11,
does that
Nasdaq's up
allocation
11.
to credit, does that replace what you would maybe have in, say, in government bonds, or is that complement that?
I think it can come from different pockets. I think every plan manager, every asset allocation model can think about it differently. They can think about it on the alt side for private credit versus their other alts. Like, why should I have alts in real estate equity when I can have real estate credit that yields a lot more, that's sucking out all the cash flow from the properties, not allowing the equity owners to participate? The same thing happening in private equity. You can start to balance that out a little bit, or you can take from your high-grade portfolio, whether it's governments or investment-grade corporates, and go down in credit because the economy is doing well, and and companies' capital structures are so well established at this point in terms of being able to service the debt.
You sound so bullish. Everything is green. Everything is positive. Treasuries are range-bound. That's making me nervous.
Well,
why shouldn't I be nervous about that?
The thing to be nervous about is the U.S. government.
I'm always nervous about the U.S. government.
So am I. Issuing so much debt and running such massive deficits. And some point, there's going to be that crowding out there. But right now, you don't fight the Fed. You take what they have at you. And in a strong economy, when corporate earnings are doing well, and so it's really good for credit, and in a high rate environment, you don't want to be leaning out right now. You want to be not that roaring kitty, and you want to buy value, and you want to have it well structured. You want to have all your protection in place. You want to know you're going to get paid your par plus your accrued. But you do all this fundamental work, and you put that money in the ground and just let it work for you.